Okay, I think it's 4 p.m. We should start on the dot. First of all, thanks to everyone for joining us today, including our two distinguished guests, Nikhilesh and Cindy. Very happy that all of you can join us for this second session. Hopefully you enjoyed the little comic strip, Dilbert, one of my favorites, on the topic that's relevant to what we're discussing today. So in the last session, we covered what it means to be a good entrepreneur, hosted by Juhok and Ben, and two of Vertex Portfolio's founders. This session will explore the topic of fundraising, and basically what that means is how to get money to execute your plans to conquer the world. I'm pleased to have with me today two experienced entrepreneurs and fundraisers who have been through multiple rounds of successful fundraise to share with you their experience and insight tips. Cindy is the founder of Sunday. This is a full-stack insurtech startup that is transforming the entire insurance value chain in Thailand and very soon Southeast Asia. Nick is one of three founders of Validus Capital. Validus is the leading SME financing marketplace in Southeast Asia. They match alternative pools of accredited and institutional capital to the huge underserved working capital needs of SMEs. This session will start by I'll provide a brief presentation outlining some of the key topics of interest when we talk about fundraising. And following that, we have Nick and Cindy to share their experience in a panel discussion. There will be time catered at the end to answer the questions from the audience. So please do submit your questions using the Q&A feature. So without further ado, I think to kick things off, let's perhaps just run this straw poll, get a sensing of the audience that we have with us today and your topics of interest. And we would appreciate if you could respond to this poll questions over the next 20 seconds or so. All right, Cheryl, results coming in. Shall we have a look? Is it coming up? Okay. Is it on screen? Perfect. It's a bit small for me to see. Planning to start a fundraise. 15%. My startup is currently at pre-seed or seed stage. Great. First-time entrepreneurs, welcome. My startup is currently at A to C stage, D stage. Okay. And the third question. Wow, scroll. Yeah, scroll down. Okay. In terms of topics of interest. Who should I raise from? How much should I have? I think quite evenly spread across the options. Don't worry, I think we have all the topics covered in our session today. So looks like this will be a very interesting session. Right, so if I may, I'll just kickstart with a primer to the panel discussion later, just addressing a few key topics. Let's start with an overview of the life cycle of a startup, which can be broken down into a few phases. The first phase is proof of concept. Founders typically at this stage identify the problem, develop the plausible solutions, they validate the hypothesis through research surveys, develop and test their minimally viable product. And entrepreneurs typically fund their activities at this stage out of pocket, or they may raise capital from angels or seed funds. Right? From the statistics, typical amounts raised at this stage ranges between 250,000 to 1 million, and sometimes more, especially if you're in deep tech and then a lot more capital is needed to go into R&D. Okay, next. The next stage is Series A, commonly referred to as the first institutional round. This is where early stage VCs come in, and typically startups approach Series A funding post-product launch and when they have strong signals of product market fit. This could be user growth metrics like your DAU, MAU, retention, etc. That becomes relevant, and also when you're able to show some early revenues. Typical round size, 2 to 15 million. Subsequent rounds are known as growth rounds, where capital raise is expected to be deployed into ramping up revenue growth. This happens when the company is confident of its product market fit and go-to-market strategy, and is looking to scale business operations. And several types of investors focus at this stage, including some of the early stage VCs, as mentioned earlier, with a larger fund size that are able to do a few more follow-on rounds. Dedicated growth funds and also technology-focused private equity funds start to play in this space as well. Next. And the later growth rounds and pre-IPO rounds, we start to see participation from crossover investors, right? Those that have the ability to invest both pre and post IPO. Now, many have heard that VCs are targeting 10x returns in every investment that they make. I think it's helpful, especially as an entrepreneur, to understand, the psyche and psychology and motivations of the person you are trying to raise money from. Now, let's assume a VC is managing a $100 million fund. Many VCs have a 220 economic structure. That means a 2% fee, 20% carry. Typical fund life is about 10 years. So from the $100 million fund that they raised, roughly 20 million will go to fees, right, over the life of the fund, leaving investable capital of about 80 million or so. Next. Rough heuristics in terms of VC portfolio performance is that 1/3 of the portfolio will fail, right? This yields 0 returns. Another third doesn't perform as expected, right? Laggards in the portfolio and returns conservatively the amount invested. Now, the remaining third is really what makes or breaks the overall performance of the fund, right? If the remaining third returns 5x per investment, this translates to a total fund return of 160 million, which translates to 1.6 times cash on cash, or roughly 8% IRR. Now, GPs typically would not be happy with this outcome, especially if they have to clear a hurdle rate, which is typically around 8%, before they start to receive any carried interest. And if the remaining third of the portfolio returns 10x, the total fund return becomes nearly 300 million, representing a 3x cash on cash return, a rough IRR of 20%, right? GPs in this case receives the carry on the excess returns above the hurdle, right? This is a happy outcome. And then this is really the reason why VCs set such a high hurdle when it comes to evaluating the opportunities and making sure that they have the conviction that this opportunity will return 5 to 10x at the end of it. Another question often asked by first-time entrepreneurs especially is how much money to raise. Now, there's really no prescribed formula for this because it all depends on the nature of the business you're trying to build, right? If you're a deep tech company requiring an army of data scientists or engineers to build a solution, you will need more. If you're in a competitive space and customer acquisition costs are expected to be high, you need more. The key questions each entrepreneur needs to ask prior to each fundraise comes from clarity of what the round is trying to achieve. So if you're raising a seed round, how much do you need to get to an MVP so that at Series A, you can tell your potential investors that you have launched the MVP and you're able to demonstrate early signs of a product market fit? If you're raising a Series A, think about what revenue you're targeting to deliver in a 12 to 24-month time frame, which will impress the next round of investors and justify a healthy step up in valuation. Next. Now, the next question will be how much capital is required to deliver those milestones that you have defined, and how much you would expect to spend on product development, marketing, sales hires, and the overheads as you grow the team, right? This will determine the amount that you need. And you should always add a reasonable buffer because we all know Murphy, and it's always also advisable to build in a 6-month lead time for the next fundraise. So make sure you have enough funds to hit the milestones and enough of a buffer to make sure you have the runway to complete your fundraise. Taking this bottom-up approach gives you a clear idea of what is needed and enables you to clearly articulate your capital deployment plan post-fundraise. Now, with regard to valuations, there are various factors that can influence valuations. One is the stage of the company. The more risk that remains on the table from the investor's point of view, the lower the entry valuation relative to the expected exit value needs to be for the investor to have conviction that the returns are commensurate. A company that executes its plans well tends to see valuation step-ups in progressive rounds. Another factor is investor interest. This is basically, scarcity value, right? If you're able to generate investor interest beyond the amount that you're trying to raise, you're in a good negotiation position. Related to the second point is the attractiveness, trendiness of the sector that you're in. VCs, like everyone else, are prone to herd mentality. And if the technology or sector that you're working on is hot and investors are looking to pile into it, then the demand and supply balance will work in your favor. For revenue stage companies, your commercial metrics will come into play as investors are now able to benchmark and compare your operating performance against competitors and industry norms to form a view about fair valuation. And lastly, this factor is really an externality beyond the control of the entrepreneur, but the macroeconomic environment clearly will have an influence, but it's something that has to be managed by the entrepreneur flexibly. Now, with regard to the mechanics of valuation and expressing valuation, it's actually a very simple formula, right? The value that you think the company is worth prior to the round is called pre-money, right? Adding the amount you're raising to the pre-money gives you the post-money valuation of the company. And the amount that you raise determines how much you'll be diluting your existing shareholders. So in this three-variable formula, I would argue that the most important and least fungible variable is the amount that you raise. As mentioned earlier, I think it's important in every fundraise to make sure that you have enough capital to execute your plans and deliver the milestones. And founders should be realistic with regard to pre-money expectations. Many founders make the mistake of over-optimizing on dilution. And typically they compensate that by having higher or setting higher pre-money expectations. Now the typical dilution per round is 15 to 25%. This is not a hard and fast number, but I think it's a useful kind of rule of thumb to think about. And one of the first lessons that I learned joining Vertex is 100% of nothing is nothing, right? And also, to give you some comfort in terms of, VC mentality, I think good VCs are very wary of founder dilution as well. They know the impact of that, and they will ensure that the founder has enough skin in the game to be motivated to drive the ship rather than to hand over the card. Higher than normal valuation is not always a good thing. Companies can run into trouble at the next round if actual growth falls short of future investor expectations. And the last thing that you want to do is to have to raise a flat round or down round at the next round. And this is clearly, a bad signal associated with companies that have failed to deliver on their plans. Next slide. Now, when it comes to investment pitches, I think most of you would have done your background reading and research. The template and framework is pretty standard. But here are some common tips and pitfalls to avoid when you pitch, right? So the first one really is that you should avoid falling into the category of or being packed into that hole called solution looking for a problem. So always start with clearly articulating the problem you're trying to solve. Some entrepreneurs start with the technology or the solution and are so enthusiastic about expressing that they leave the investor wondering what is the unmet need that they are trying to address. As far as possible, explain your solution via a demonstration of your product. It will be much clearer and more engaging. The third point is that you should not oversimplify your representation of the addressable market. That's something that we actually see quite commonly. As a general example, say if you're developing a cancer drug, do not simply claim that your addressable market is all the cancer patients in the world, right? You should kind of define which type of cancer your technology is able to address and which markets, which geographical markets and regulatory bodies you intend to target. The risk of oversimplification is, to give an impression to the potential investor that you're trying to pull wool over their eyes, or you don't have a good grasp of the market, and that should be avoided. Now, on competition, there is always competition, especially if you're operating in an attractive market space. So similarly, don't try to kind of avoid that point. And I think the next 2 points are quite apparent. So lastly, on the funding plan, as mentioned earlier, investors like to know what they are investing and getting into. So clear articulation of how your capital will be deployed, and your plans, and what milestones you expect to deliver for the investors will help give the investors greater comfort and conviction. Next slide. So the objective of the fundraising pitch really is to impress and score well on your target investors' list of investment criteria, right? Roughly kind of represented by that diagram on the top left. The point is to have your investors, enter into a fear of missing out mode by, convincing them that your company is an outlier opportunity that they cannot miss, right? Another tactical suggestion is really to conduct your fundraising campaign in parallel rather than in series. Beyond the obvious advantage of compressing timelines, you also mitigate the risk of having one potential investor spoil your opportunity with the others. Grapevines within the investment community are strong, and word does get around. Well, a few more kind of tips and pointers to round up. First of all, I think VCs who have been in the game and have been through venture cycles understand that linear growth to success is rarer than finding unicorns themselves, right? You want investors who are able to ride through rough patches and your pivots, rather than those that bail at first signs of trouble. Good investors limit their role to being good mentors and sounding boards. They do not try to take over the steering wheel. If given a choice, choose quality of investor over the valuation offer. It is often important to execute well and to manage your existing investors well. Whether or not existing investors take up their pro rata at the next round is a very important signal for the next round of investors. Good VCs tend to flock together. Nature of the business remains very cloudy, so try to do your research and be very selective about who you bring on board in each round. And if you can, select investors well and avoid having too many small investors on a cap table. Long cap tables and complicated structures can be a turnoff for future investors. Right, and with that, I think let's turn the spotlight over to the two founders who have joined us today, Cindy as well as Nikhilesh. Hi. Hi,
James.
Great. So just to kick things off, Cindy, Nick, maybe you can start each by introducing your company in a bit more detail and share with us briefly your fundraising journey and credentials. Maybe ladies first. Cindy, would you like to go first?
Sure. So James, thanks so much for having me today. So my name is Cindy, everyone. Thanks for having me here. So Sunday, we're a full stack insurer, applying data models and technology to provide complete products and services across the insurance value chain. So we're a startup founded in Bangkok, Thailand, back in 2017. And since then, we're focused on all types of non-life insurance products. So stretching from healthcare to electronics to motor and to travel as well. We've raised in total 3 rounds, totaling about 30 million US, if we include the latest round that I'm hoping to close next month. And our cap table includes Vertex, Kona Capital, Line Ventures, and 2 more CVCs for the latest round.
Great, thanks for that. Nick?
Hey, thanks, James. My name is Nikhilesh. I'm CEO and co-founder of Validus Capital. We are one of Southeast Asia's leading online marketplaces connecting SME borrowers with accredited investors. The idea being that small businesses have always been underbanked and unbanked by traditional FIs. We build our own sourcing channels, use alternate data to score these SMEs and get them financed by accredited investors, which can be HNIs, family offices, hedge funds, and the likes. We are now present in Singapore, Indonesia, Vietnam, and just setting up Thailand as we speak. We've raised a little over 35 million US across 3 rounds and are funded both by Vertex Southeast Asia and Vertex Growth. In addition, we also have FMO from Netherlands, Open Space Ventures, the Kwok family, Cathay Financial from Taiwan, Vina Capital, and Adventures from Thailand.
Great, that's a broad swath of investor groups that's represented there. So, well, maybe the next question, let's have Cindy perhaps give us a few comments. What were some of the key factors that you think contributed to your success in fundraising?
Definitely finding a strong lead. So working within the insurance or the reinsurance market is quite specialized and niche. So having to do a lot of research, prioritizing the right selection of target investors to go out for is definitely important. Finding a strong lead also to help you sort of develop your future funding pipeline, which will make your life a lot easier in the next future fundraisings, is definitely important. So I think that definitely played a role. The other one I think is working really hard on your projections and also your data prep. So laying it out clearly, what are your successes in numbers, and sort of mapping that out and showing your growth direction gives a lot of, could build interest and also confidence, and sort of helps in terms of market sizing and positioning of your company in the future. And also I think most of all is learning more about your potential lead as well. So from my past couple rounds of fundraise, once you've sort of identified a strong lead, definitely the next step would always be spending at least 1 or 2 days. They would be wanting to meet you face to face. So definitely you should prep ahead. Everything from product demos to showing them your processes, walking them through your numbers, talking about your GTM, go to market, what's your strategy, definitely meeting the team as well, because a lot of the founders, a lot of the investors look at you as a leader, but also they want to know your team because it's important for execution. So I think definitely preparing all of these things ahead is important for success.
That's great. That's a long recipe for a lot of first-time entrepreneurs to take in, but we'll break it down later. But before that, maybe just to turn the coin around to the other side and ask Nick, can you share with us some of the key challenges that you have faced during your fundraising journey? And what would you have done differently?
Sure, James. I think in hindsight, everything could have been done differently, but we are very happy with the way things have played out. So wouldn't want to change the outcome in any way. I think across the 3 rounds, each one came with its own set of challenges. Series A for us was very interesting because we did not spray and pray. We were very, very focused in the type of investors that we wanted. And we just had Vertex along with a few angel investors who came into that round. I think the challenge that round was trying to find the right set of terms that work for everybody. And we're quite happy with that outcome. Come Series B, that's where we had a whole host of investors who came in. I think the focus then for us was to focus more on corporate venture type of investors because we felt there was a lot more value add there. But Series B plus, which was the last round, was bang in the middle of COVID. And you were a part of that, and that was definitely very challenging because I think the entire fundraising process kind of spun on its head. The kind of questions that we anticipated versus the ones that we got asked were very different. No more was it about just growth story, burning cash and growing recklessly, but the questions were now very, very focused around how much runway do you expect to get, what are your unit economics, when are you going to turn profitable, and most important, what if the world doesn't improve? Are you prepared to survive and grow in this new normal? And that was an interesting experience, challenging, but also forced us to think and operate in a very different way.
Okay. I'm looking at the list of questions flowing in. I see quite a few that relate to how you select investors, right? So maybe Nick, just staying on with you, the venture investment ecosystem is made up of different investor types, right, with different investment objectives and styles. And the Southeast Asia ecosystem now is very vibrant, so you really have a breadth of options available. So how did you prioritize and target investors to approach as you prepared for each round of fundraise?
That's a good one because all my life prior to Validus, I've spent in private equity, M&A, investment banking. So I've worked with a whole host of investors from big to small. We were extremely clear about the kind of investors that we wanted, and the few important criteria. The first was value add. I think the most misused word in investing. Everybody talks about it, very few actually do it. I think being in the fintech space, we were very clear that we wanted credibility, we wanted introductions, we wanted experience, and we wanted help with regulations. People who are experienced enough, who've done this, who can really handhold us. That automatically narrowed down the VC pool to let's say the blue chip VCs who've really been there, done that. I think the second is more of a personality fit, both between the individuals at the venture capital firm and the founders, as well as between the firms. Right? There are different VCs, some who believe in growing at any cost, where just scale matters. There are others who are more balanced, who appreciate, the style that the company wants to grow with. So we were very, very clear about the personality fit. We would not want somebody to be on the board who doesn't kind of, believe in the way that we want to grow. I think these were two. And the third is something that you had touched upon, is VCs who are here for the long run. I've seen firsthand that often if your existing investors do not re-up in the next round, it can be a death knell for the company. So we were very clear to focus on investors who would, ride along with you at least for 2 to 3 rounds. Because I think when things are going good, everything is good. But it's when the chips are down is when you want your investor to kind of be your guiding light. And that's one of the reasons why I think we've continued to grow and done well, even in the present scenario.
Just to go down into a bit of the nuts and bolts of it, right? I mean, all these are very salient points. But could you share, like, in the process of preparing for the round, how did you collect the information relating to these parameters of each investor? How do you build up your research on the investment landscape?
Sure. I think there's a lot of information online, right? Every single VC has, their investment philosophy, their areas of specialization, the team that they have, and their portfolio, right? These are things that can be easily done using secondary research. So that's where, for example, if we are a fintech firm, we really don't want to go to VCs who are only investing in deep tech, right? We're really not a deep tech firm, or VCs who only do, say, consumer/e-commerce. So we wanted VCs, where we would have a fit. The second is the size. If I'm raising 5 million, there's no point going to folks who are, who only write $1 million checks, or those who write 15. As a founder, you go to 10 wrong VCs, you spend your energy, it really brings you down. So you need to know exactly who you're going to. The third is the value add, right? It's important that, yes, you get a check, but what is it that you want along with the check? Do you want an active investor, or do you want a passive investor who writes a check and forgets about you? That works very well for some folks. We wanted somebody who had kind of, handheld founders and worked in certain ways. We are a fairly experienced team. The average founding team age at our case was close to 40 plus. So we didn't really want, 20-year-old associates sitting on the board and telling us what to do. We wanted slightly more experienced VCs to guide us along the way. And I think the last is primary research, which is, do ref checks on the VC from the market. How are they? How do they treat their portfolio companies when things go wrong? Speak to some of the founders that they have invested in. Are they activists? Do they support you? Do they always try and voice their own thoughts on you? I think there are quite enough resources where if one does effort, you can come up with a fairly decent due diligence on the kind of investors that you want.
Yeah, I would say, Nick, you're very thorough in your primary diligence on us. I think we probably put you in touch with quite a few of our other portfolios as well. I mean, both Southeast Asia as well as growth fund side. Cindy, maybe turning the same question to you as well. I mean, being in the insurtech space, are there certain parameters that you started out with in terms of identifying or limiting your kind of range of target investors?
Yeah, definitely. So I agree with all the points that Nick mentioned is very important, and particularly also for our business model, because we're also an insurance company ourselves, i.e. we have the license. So my priority was definitely targeting a VC with a minimum fund size, because you need to be confident that they will follow and participate in the following rounds. So that was my immediate priority, trying to really develop a funding pipeline for the future rounds, as I mentioned previously before. And also because we operate in Southeast Asia, and each of the markets, whether it's Thailand, in future markets for ours like Indonesia or Malaysia or Singapore, they're very highly localized. So looking for CVCs who would really help you in that particular markets could really add benefit to you as well. So that's why, as you can see, if in my future later rounds as well, we started targeting a little bit more of the CVC side to also assist us on that. Yeah.
Well, good that you touched on your experience and selection of CVCs and financial investors. I think one of the common questions that's asked about this topic is with CVCs there's always a double-edged sword because there's a strategic business core business behind them, and they could be in the same space. That's why they're interested in you. How do you manage that kind of dilemma between having a potential competitor or industry incumbent having an inside view on what you're trying to do, which may eventually end up disrupting it?
Yeah, I think we need to decide whether it's about disruption or whether it's about collaboration. Let's say whenever I decide, for instance, example, if I were to ask for money from another insurance company who could be competing within the same space. So we need to answer that for ourselves first. And the other thing is, if you're looking for a CVC, what exactly are you looking for? They definitely should be relevant to your business plan. They should definitely help you to scale, launch a product, or build trust for you as well. So I think it's very subjective. Definitely, we have to exercise our judgment to learn the strategy of that CVC as well. How they work with startups. Are they prepared to work with startups? It's no hard and fast rule as well, but definitely a lot of these questions you need to answer for yourself. Yeah.
Okay. Just switching gears a bit and just talking about how your fundraising experience has kind of evolved and changed as you move from seed round to Series A, Series B, and subsequent rounds. What can you share with the audience about the key things to note at each stage and what is important? Maybe starting with Nick.
Sure. So like I touched upon, James, I think Series A was kind of the one of the charts that you showed there. It was all about how good is the team, is it a well-rounded team, is the team going to stick around in good times and bad, the product market fit, what's your unique angle to solving the problem, and the size of the addressable market. Series B was more about seeing traction around the same and whether we were being able to build the second rung of management to support us as we go along. I think Series B plus or Series C is very different. That's where the unit economics start coming into play, because the story can and the promise and the dream can only get us so far along. So have you built the technology? Is the technology kind of now firing cylinders and pumping the growth? Second is, by this time the company should be dependent on founders, but there should be an independent management team who's going along and pulling their own weight. The third is by this time, the company should have pivoted a couple of times. So have you actually, over the course of these pivots and these flip-flops, found that secret formula that you are now going to replicate and scale, right? By this time, there has to be a very clear path to scale. I still cannot be conducting too many experiments to figure out where I'm going. And this has to translate into numbers, which is how many customers, how much are you making per customer, how much are you burning, and what's your acquisition costs. I think one has to be very clear that you keep on knowing, how the story is going to be and start preparing. I've seen often where, folks really don't know, what the goalpost is. And when the goalpost changes and you're not prepared for it, that can be quite a lot of trouble.
Thanks for that. Just moving along, because we've still quite a long list of questions. Cindy, in terms of investor pitch, can you share specific tips or pitfalls that you have avoided?
Yeah, sure. So definitely knowing who your audience is for the investor that you're meeting. So definitely, I agree, never get carried away with just focusing on your data tech or your data model solution and diving too deep and quickly into the technicalities. Definitely pitch to them what's your vision. How do you, more importantly, commercialize your product? I think, and also really paint the picture on how you would be a significant player in the future, because I mean, every entrepreneur, when you start and build your business, you want to make an impact. So you need to do your market sizing, know how you position your company, demonstrate that you know the market very, very well, especially when you're operating in Southeast Asia as well. The second one, I guess, is also working on your financial projections. So really making sure that you show clearly which is the channels or the products that's really showing traction, those where you've failed, how you've sort of like switched key learning. So it's all about key learning as well. I do believe that investors don't expect everything to be perfect. In fact, they expect flaws, but how do you actually really bounce back from that? So I think I would definitely focus on those two.
Right. And I guess indeed for you, there's an added challenge, right? Because, for Sunday, you operate within the insurance space, which is very highly regulated, right? And very specialized, not well understood by many outside of the industry. So how challenging was it for you to convey the significance of your competitive advantage, right? The fact that you have a full stack, you're a full stack insurance player with a license that may be lost on people who don't know how important that is within the industry. How did you overcome that? And importantly, how do you do that without, making the investors, feel embarrassed?
Yeah, it's still a challenge until today, if I may say so, but it's getting better, I hope. So yeah, it's very challenging. I think insurance, and in the reinsurance industry globally, it's not something which everyone is immediately familiar with, or they hear about it every day. And the product by itself, risk is very abstract. So your product dimension could be really vast as well. So like, how do you swim in it and explain what exactly is your product? So it really is challenging, and not to mention there's like technicalities around the insurance accounting projection. So whenever an investor looks at my financial projection, it's scary. So to a lot. So we have to really break it down for them. I think over the past few rounds that I've done, my experience is definitely treat your investors like your customers first. Make sure that you're pitching to them as how you normally pitch to your customers. Start from what are the how would pitch your vision, how would their experience be with you when they buy a health insurance or electronics protection or car or travel. And the second one is then do a lot of industry and customer journey education. So lay out the end-to-end customer journey process, or then after that you get into the technical process, lay out and highlight what are the complications that the market is facing at the moment, all the pain points, and then start showcasing how your data models or your data and tech sort of helps to simplify it and scale and is scalable in the longer run, because you want to build your business. So the idea, I guess, would be to demonstrate, let's say, the deeper that you own the customer journey, then the more comprehensive and creative your products and solutions can be for your customer, and that sets you apart from all the other current players. Because at the end of the day, insurance is not a hardware product. It's all about a service. So you need control of that service. So I always definitely do a lot of explaining and pitching around that. The other one is always, because there's not a lot of material and literature out there about insurtechs or insurance, and even if there is, it's like super technical. So often what my experience is that investors come in sort of measuring you against what they've already observed other insurtechs in the global markets. So you always have to be prepared to know your competitors, not only within the region, nationwide, I mean globally, because there's only so few of us right now, but it's growing fast. So that, and once you are more aware of your competitors as well, definitely understand and prepare on how you actually are different from them. So I think this is how we've been trying to do. Yeah.
Well, thank you for sharing your deep insights on this topic. Nick, just moving down that fundraising process, assuming you found the investors, right, and you're at the deal negotiation stage, what is your approach to deal negotiation? I think we have a subsequent session talking about the specifics and the technicalities of deal terms and all that. I think about for today, let's talk about in terms of mindset and your deal negotiation strategy. What would be your priorities?
Sure. James, I think some of the basics, right, which are negotiation 101, doesn't matter whether it's a term sheet or any other part of life, but we won't get into that. I think what works and what's worked for me over the years is being very clear as to what are the must-haves for us and what are the good-to-haves, and kind of break it down. So at the beginning, make it very clear that, I mean, which are the ones that we will not budge on, and what are the other ones that, somewhere we are able to give. And then for me, I think it comes down to a give and take relationship. Got to understand what are the must-haves for the VC also. You kind of divide those between up, and then every once in a while you keep giving into some of the terms so that it's a win-win for all. I think that is one. The second is also trying to go beyond the legalese and understand what is it that the other person wants. Often we get mired in the legal language or the clause. What the investor is doing basically is trying to protect their rights when things go bad. So can we offer something else that works equally well, which, a basic term sheet may not have? So, there are times when we've gone around structured terms or done things completely differently, trying to protect that investor's risk as well as finding a clause that works for us. But I think one tip for a lot of folks is what they may not know is that your first term sheet or the first legal agreement is the most important one. That becomes almost like a base for life. So anything that you give away, you've given away for life. One hopes that, okay, I'll give this away in Series A, but in B or C, I'll get it back. Unless you're like a Grab or a Facebook who's done extremely well, for most of us mortals, anything that you've given away. So the rest of the rounds, just use them as a template.
Yeah. And I think, perhaps a perspective from the investor's side as well. I think over the years, as the Southeast Asian kind of ecosystem has matured, I recall in the earlier days, even Series A rounds, we came across terms or deal terms that were pretty strange, right? And I think now it's pretty much a mature environment where people know what are the standards and what are the norms. I guess the advice to entrepreneurs is that it's not difficult to discover what are the standard deal terms, and especially in the earlier rounds, right? It's perfectly okay to go with a standard template, right? And when investors start to ask for very difficult or strange or non-market terms, you have to weigh the considerations and also think about how these terms may affect you in the following rounds, because these things tend to get enshrined and they tend to have a long tail effect for the subsequent rounds. So be very careful about what the investors are asking for and make that trade-off balance very carefully.
In fact, I have founders who, everybody uses a law firm to represent them, but the law firm is just responsible for drafting what you have negotiated. The onus doesn't go away from the founder from doing their own research, through the internet or by meeting other founders and really understanding what each term stands for. That's very important to kind of go beneath the language and figure out what the term really means and how what's the implication when basically things go bad. Because that's when all the legalese comes into effect. The second is it's also a good yardstick to measure two different VCs. If somebody's giving you terms which are really crazy, then they're probably not the right folks because they're trying to squeeze out something which is unfair. I think most good VCs would not really present a very, very unfair term sheet right up front.
Well, that's a good segue because a bit of pre-selling. The next two sessions in our series will address the technical bits about the term sheets and your legal terms. So this is a question for both Cindy and Nick, right? And very relevant to the current environment. I think given COVID, it has arguably made it a lot more challenging to fundraise, right? Both from just the macroeconomic point of view, and also at a very kind of operational, technical level in terms of arranging meetings and getting face-to-face. Is there any advice you can give to entrepreneurs to better their chances of success under such a situation? Cindy, would you like to go first?
Sure. I think definitely review your business plan and prolong your runway as much as possible because unfortunately the market conditions are very uncertain right now. So you have a good product, you have a good business, but unfortunately a lot of VCs right now are occupied ensuring that their existing portfolio companies are okay. or they're, you know, playing a wait and see, and they're not in a rush to immediately put their money in any company yet. So you really have to ensure that you can survive and ensure that your operations are solid. The second one, I think, is I always like to say that crisis is always an opportunity for many people as well. So really try and look at this to see if you can adapt. I mean, you're a startup. You know, building a new age company is all about adaptability, resilience, making sure that you still have growth. So if you can do that, that's a massive plus point. I really do believe that. Another one is also if, let's say, you're in the middle, let's say you want to raise a very large round, maybe sort of come back to the drawing board and think about it again, maybe raise a smaller round, prioritizing and finding investors who could sort of maybe sort of put money and consider you at a faster space, you know, so have to really think about that again. And at the same time, once you have that, definitely not to forget to also engage your other investors, because you want to be prepared whenever there is a market rebound or when the market is ready or other investors are ready, you can already immediately jump on board. So definitely this is even now actually what I'm doing. Yeah.
Great advice. Nick, anything else to add?
Sure. I think, you know, there are two ways to come out winner. One is to outgrow everybody. The second is to outlast everybody. So I think, you know, going by Cindy's advice, which is just make sure you survive, right? So now is not the time to be cocky, but make sure we have funds and runway in the bag. I think, you know, every crisis has an opportunity. A lot of startups may not survive. So if you have money, you will, and the road after that becomes clearer. I think what we did is we kind of went back to the drawing board saying, okay, you know, what has COVID taught us? You know, what has, you know, an Uber listing or a WeWork fiasco, you know, how has that changed the investor mindset? We bounced out some ideas and said, how do we tailor our pitch? You know, if we are not growing at the fastest clip, can we instead showcase the resilience of our portfolio? Can we showcase the stickiness of the customers? Can we showcase how we have cut out slack and extended our runway? You know, how can we kind of use the new drawing scale to just showcase our skills and benefits and kind of, you know, come out on top? And I think the last is timing becomes important. We have less time for a fundraise. So it's important to kind of map out that VC world, figure out who are the ones writing checks and who've gone into cold storage, and focus all energies just on the ones who are writing checks.
And just moving down that process, right? Beyond closing the round, what would be your advice for entrepreneurs in terms of managing new investors? And of course, some of them will be on your board as well. And you know, and start preparing yourself for the next fundraise.
Yeah, this is very close to my heart. I've been an investor for a very long time. I think the one thing the investor hates the most is surprises. Yeah. I think if you've chosen your investor correctly, then they got to be like a partner in the business. And I think, you know, we often don't give investors their due. They have seen enough of these companies to know that things don't go as per plan. I think one thing we do is be very proactive with our investors. Don't wait till the board meeting. You know, I literally trouble James and Genping on a regular basis to let them know what we're thinking, how things are going, right? So good investors, you know, take bad news into stride and work accordingly. I think that's one. The second is to always prepare for the next round, which is the moment we close this round, we've already kind of got a map of who could be potentials for the next round, and we start sounding them out. And it's more of a coffee conversation about letting them know who we are and what's our plan. I think nothing is a better pitch to an investor than having told them a story 18 months back, and then when you meet them again, to show that we've kind of, you know, walked the talk and implemented what we had promised. Because then the investor almost feels as if, you know, he kind of knows you, that you're an execution horse, and that works really well. So these are two things that we do with existing as well as prospective investors.
I would just say that the exception is that investors like to be surprised, but only on the upside.
Yes, for sure.
Okay, last question before we jump over to the Q&A from the audience. Besides equity funding, have either Sunday or Validus considered other funding options? What is available out there?
I think from our perspective, there's always friends and family and angel money. We'd gotten a few angel investors in each of our fundraisers, but these were again individuals who very specifically had value to add. The second is venture debt, which often comes hand in hand. I think conventional debt is not open for startups like us. There is, of course, P2P lending, marketplace lending. We often finance startups who are in the B2B domain, where they have invoices to discount. This can be a very attractive source of funding for startups who are, acting as a bridge till they get to an institutional round.
Okay. Okay, so we have a long list of audience Q&A to go through. I think, the first one is, I think, relevant for both. This comes from Dennis Ye. Is it better to have one first-tier VC investing in you or multiple 1 to 2-tier VCs investing in you across multiple rounds? I guess it's a question of, if you have options on the table, how would you kind of build your ideal or optimal investor syndicate?
Okay, going first, I mean, we obviously chose having one tier 1 VC to start with. I think it's easier to have one sounding board initially till you're ready to handle multiple VCs. It's also important to have VCs with similar thoughts and style. The last thing you want is to be caught between two giants who have competing styles or egos. So I would always recommend going with one solid blue chip VC to start with, and then slowly building your investor base with different investors who bring different things to the table.
Cindy?
Yeah, I definitely agree with Nick. So it was a dilemma as well that I had to make a decision in our Series A. It was between two tier 1 VCs, and being a founder, you get carried away sometimes, like, oh, I want to be the first startup to have 2 tier 1s. I'll be the talk of the town. But really, when you look into practically how you run your business, what's your focus, it doesn't work that way. So I definitely agree with Nick on that.
Great. Next question comes from JJ Tan. From your respective introductions, seems like neither of you has any intellectual property protected. I don't know whether that's true. Having this at your first round of fundraise, have any investors asked you, what if your major competitors were to do what you are doing? And what was your response?
I think the first question is whether your solution that you are developing is ready to be patented to begin with. So you definitely need to run a research on that. The second one is that do you really also want to get it patented, because it depends on how fast your alterations are to your particular product. So it depends. So I think, but it wasn't, from my experience, it wasn't really a key question from the due diligence or the pitch with the investors. Yeah.
Yeah, I think for us too, going with Cindy's flow, there are different types of business models. One which are IP driven, one which are not. For a marketplace, part of our pitch is to tell folks that the barrier to entry in our business model is 0, but the barrier to scale is huge, and that's credibility. Credibility comes from execution. So our IP relies in the execution. Our IP relies in the in-house algorithms that we build on the basis of machine learnings and artificial intelligence. A lot of these things cannot be patented, but IP sometimes is overrated. Some of the most successful businesses have been built on the strategy and pure execution, and I think I'm a strong believer in that.
Okay, next question is a very practical question. It comes from Paul Martin. How did you balance time and effort fundraising whilst keeping the business on track? Is there particular preparation you would suggest for founders to do before embarking on fundraising? And I think Nick, Cindy, your experiences will be quite different. I think Nick, you have co-founders, and Cindy, you're pretty much the main driver. So do we have the comments?
Yeah, I struggled. I still struggle today. In fact, my first couple fundraising rounds was hell. I didn't sleep for at least 5 months because you have to run the operations and also fundraise at the same time. And what I didn't, the dilemma for me is as a founder, you want to ensure there's a funding pipeline. but I was even more afraid of having to, bring in my other team members, my other leadership members, because they also need to sort of be 100% focused on operations. So I think I have to say it. Starting your own company, your own business, it's always tough in the start. But I think you can always make your subsequent rounds a lot easier, making sure that your data room is always there, updating it regularly, making sure that your data prep is, as mentioned there. And once you understand how the flow works, it gets a lot easier. Definitely plan ahead. I think that would be the advice that I can give. Yeah.
And Nick, how did you handle it?
I think from my perspective, hats off to solo founders like Cindy. I don't even know how they do it. My advice to everybody is just make sure you have at least 1 to 2 more co-founders. I think it makes life a lot easier. You always have somebody to bounce off ideas, to kind of, hold things when things are not going your way. Allows you to sometimes pick up pace and sometimes, gather your energies. Between us co-founders, we very clearly demarcated areas. We played to our strengths. So fundraising was something I'd done in the past. When I was out fundraising, somebody else would be taking over the business and vice versa. So I think that formula works very, very well for us, where you kind of isolate and just straddle your areas of strength.
Right. Next question comes from Ada Lin. Would you think getting a loan is a better option to grow in these market conditions? I guess she's referring to the current COVID conditions. And since there are some attractive corporate loan schemes and VCs are hesitant to invest at this moment. I think, Nick, this could be teed up for you.
I would be very curious as to what those schemes are, because I have $20 million in the bank account, and I can't even get a credit card from a bank today. Right? At Validus, to get a credit card, we have to put up cash collateral. So, I don't know a single loan scheme that we can get. We are, in fact, the only ones who would do invoice discounting, and even we would not give, pure cash loans to startups. So I think one should be very clear before kind of going down that road, whether it really exists and what those terms are. And I think also getting an equity investor is more than just getting that check. It's about getting validation for the business model. It's about, almost adding a co-founder who will kind of help you along every single way.
Except perhaps if you're at seed stage, and of course there are all the grant schemes that are still running. And I think MAS has recently just announced, additional funding for companies in the fintech space as well. So I guess it's stage dependent, right? Okay, just looking through the list of questions to make sure that we didn't miss any. Sorry, I'm getting a prompt that time's up. Oh. Can you go back to the question list? Okay, 1 second. Okay, there's a question. How can you find a right investor when the idea and value proposition challenges a well-accepted scientific principle? In my instance, interested parties had sought verification from experts in the field, which is not forthcoming because it challenges those principles. I think this might be a hard question for both Cindy and Nick to address. It's quite a different domain. Let me move on to another one. But I would say that maybe if I recast the question, right? If you are working on something that's so novel, right, and really that's not well understood at all, kind of similar to Cindy's experience operating in a space that investors are not well understood. How would you? I guess the task of convincing investors obviously would be harder. So, I guess another way to ask that question is, what is there any tips or tricks that would allow you to better convey and convince your investor if you're operating in a space that is really unexplored previously? Nick, Cindy, probably an unfair question, but want to have yeah.
I guess, James, if I figured out how to make wine from water, then I would probably just explain the business case in a very simple way to the investor. if the investor believes that there are super normal returns to be made, then the onus is on the investor to do their due diligence and figure out whether it works or not, right? So I think it's all about building that business case and explaining what the business potential is there. And, because the investors, the part of, that 2% fees is to figure out which are the right investments, do their own due diligence. And, they have a lot more resources to hire experts and figure out whether it really makes sense. It's often not about the scientific theory that you have cracked. It's about, what is the business that will be built around it, the use case and the returns that will come from it.
Okay, maybe one last question to close it off, and I think both Nick and Cindy should have a go at this. This comes from Jeffrey Jump, a very short and sharp question. All VCs claim that they are smart money. How do you determine who really is smart?
I think definitely look at the history of the VC, the portfolio of companies that they have supported, exited successfully, currently supporting as well. I always look at the credentials of them, how many cycles of economic cycles that they've gone through. Because for me, I'm an operator. I don't know how to manage my money, and I'm still learning how to manage my money. And if there's someone to help me manage my money and guide me where to find money, that is really important. For me, I think looking for VCs who are practical is very important, and there's no hard and fast rule. You just need to meet a lot of them. Also do your research on the back. Try to talk to as many startups as possible. Find out practically how the experience has been. Yeah, I would do that.
And Nick, parting shot?
No, that's my favorite question so far. I think for me, it would be slightly different, which is, evaluate the kind of questions that the investor is asking you when you are pitching to them. Are these very, firstly, do they even get the business model instantly, or, do they just not get it? And you'll be surprised, how many times folks just don't get it. The second is, what are the quality of questions they are asking you? Are these, the same 5 generic questions, or is the person really asking you interesting questions, which can be both tough as well as, critical ones? The third is speak to their portfolio companies. If it's a private call with one of the founders or, a couple of the founders of their portfolio companies, you'll get a fairly decent picture, right? I mean, if somebody would do a ref check on Vertex, from me, I would give them the good and the bad, a fairly balanced picture, which is the best thing that you can do.
My short response would be that actually most investors are quite dumb. And sometimes it's not a bad thing to have a dumb investor. But what's really important is to have an investor who understands your space, like what Nick has mentioned, right? And sometimes it doesn't take smartness to do that. It takes, experience. It takes, a bit of persistence. And, they eventually get it. And what is really more important is how supportive these investors are and whether they have that attitude and the gumption to ride through that journey with you, and they have the capabilities to kind of work with the companies that they've invested in through troubles and towards success. So that's, I guess, a good place to round up this session. And maybe as a first, let me thank both Nick and Cindy for being so candid with sharing your experiences and being so generous with sharing your secret recipes to fundraising. And and thank you to the audience for the enthusiastic responses to the questions. I'm sorry if some of the questions weren't able to be answered, but feel free to reach out to our colleagues at Vertex, and we can put you in touch with people that you might be interested in to get more insights from, or we're happy to answer them ourselves. And a bit of a pre-marketing for the next session coming up. Next Friday, we will have Keelok, Kevin, and Hyok share with you the nuts and bolts, the technicalities with regard to term sheets and legal terms, right, in your financing documents. And with that, I wish to thank everybody and wish everybody good health in the current circumstances, and have a very good afternoon. Thank you. Thanks, Nick. Thanks, Cindy. Bye-bye.
Bye.